We want to talk about abuse of power as well as economics right now with Missouri Congressman and House Budget Committee Republican leader Jason Smith. Congressman, it's great to see you. Thanks very much for being here. So first, I want to talk to you about economics and that COVID relief money. What's your take? $1.9 trillion COVID relief package, we all know, is the root cause of the spike in inflation that we are all suffering. Where is that money and how has it been allocated? What can you tell us?
You know, for over 500 days, the House Budget Committee has been releasing different aspects of spending of that $1.9 trillion bill. They said, like you just referred to, they said that it was for COVID, but less than 9% of all that spending was towards COVID. $400 billion of the roughly $2 trillion bill was used to pay people not to work. But then there was almost $500 billion that was used on just pet projects all over the country, whether it was $783 million checks to federal prisoners, including the Boston Marathon bomber, whether it was $1,400 stimulus checks to Japanese citizens that live in Japan, $2.1 million for a golf course in Florida, $2 million for a ski resort in Iowa, $5 million for a bird sanctuary in Texas. I could go on and on.
Oh my God.
And we've been highlighting it on the Budget Committee of all this waste. We've sent over 40 letters to this administration, not one response. But now, since Republicans will be taking control in January, they will have to answer to the American people of how they're spending this money, why they're spending it, and where else are they spending it.
Well, you have done such a great job on the Budget Committee, Congressman. Thank you for lining all that up for us and laying it all out. Will you become the chairman of the House Ways and Means Committee should this materialize in the next few days in terms of the majority the GOP is taking in the House?
You know, I sure hope so. It's up to my colleagues to make that decision, and they'll be doing it very shortly. But I feel like that, just like Governor Huckabee said in your prior segment, we are the party of the working class. We're not the party of country club Republicans. I grew up living in a single-wide trailer, and then we upgraded to a double-wide trailer. So I understand the working class, and those are the priorities that need to be managed within the House Ways and Means Committee. And I feel like I'm the best person to move forward, and I'm pretty excited to see what my colleagues decide.
Well, look at now the threat of inflation. Americans are feeling the pain of high prices on just about everything. We're waiting on the Consumer Price Index. It's coming out in about 2 minutes. It's expected to be up 0.6% month over month and 8% year over year. But President Biden claims he can't guarantee to get rid of inflation at all. It doesn't appear that he actually has a grasp on what the issues are. What's most important for us to understand about this CPI report out in about a minute and a half?
I mean, this administration denied that we had inflation. Then they said it was temporary. And now they're saying that they can't do anything about it. Well, I can tell you what they can do for one, and that is stop this reckless spending. Just in his first 20 months, they added more than $10 trillion of new spending. $10 trillion. That's more than all the spending that the U.S. government did in its first 196 years of existence. So stop the reckless spending. That's a good way. Inflation coming out in the next couple moments, I think it's going to be very similar to where it has been. Inflation has risen 13.9% since Joe Biden's taken the oath of office. Maria, I actually wrote about this last week. If you look at history, everyone knows Jimmy Carter as such a horrible economic times. Inflation under Jimmy Carter, from the time he took office to the highest point, it went as high up to 200%. Under Joe Biden's watch, inflation has went up 500% since the amount whenever he was in office. So that tells you that under the terms of Joe Biden, it's much worse off than Jimmy Carter.
Yeah, I mean, we're going to look and zero in on the components of the CPI. Rent and housing is a third of it, and rent has not come off the highs at all. Food prices as well. Now, you said $10 trillion in new spending. The Committee for a Responsible Budget is talking about $5 trillion of borrowing, but the $10 trillion that you're referring to includes what? In addition, I mean, I know that the student loan bailout is part of that too, right?
Well, it's numerous things. For one, just in executive orders, Maria, he has spent more than $1 trillion in just executive orders, bypassing Congress. In fact, just in 7 of over 500 executive orders that he has signed into law, spends over $1 trillion. And that is information we got from the Congressional Budget Office. Then you look at, the $1.9 trillion COVID package, more than $2.5 trillion in new interest just because of all the debt he's racking up.
Yeah. New interest,
you can just go line by line, and it's tough. This is why the American people are paying more to put food on their table, clothes on their backs, and gasoline in their cars.
Yeah.
And they're struggling. They're absolutely struggling.
Let me just point out the market is rallying now, huge, up 600 points because the CPI is out and it's better than expected. Right to Cheryl Cassoni we go with these numbers. Cheryl.
It is. Okay, so the year-over-year headline number coming in 7.7%. 7.7%. The expectation was 8%. Inflation is cooling in the month of October. Now, headline number coming in not as hot as expected, 0.4%. We were looking for 0.6% month over month. We came in at 0.4%. Now, getting into food and energy, the core numbers, stripping out food and energy, 0.3% month over month. And it looks to me like I don't have core. Hold on. Do you guys have core? I have 6.3. I just saw that, guys. Thank you so much. All right, so core 6.3. The expectation was 6.5. That's year over year. Month over month, again, for the core, 0.3%. Market was looking for 0.5%. Up to the headline numbers. Year over year, CPI coming in 7.7%. The expectation was 8%, and this is well off of the number that we got in September, which was a really hot number of 8.2%. And again, month over month, the headline number, 0.4%. Market was looking for 0.6%. I am in the release. They're talking about shelter. They say that if you look at the increase, still the index for shelter did contribute over half of the monthly all items increase. Indexes for gasoline and food did increase. They are seeing jumps here, okay? It's just not as hot as expected. The energy index increased 1.8% month to month. Gas, electricity, those rose, but natural gas, that index actually decreased. I am in the reports. I'm just going to keep on going, guys. All right, so let's go through and talk about some of the numbers that we're seeing here. I like to look at the year-over-year numbers for context, guys. If you look at the year-over-year number for food at home, that's the grocery bills that everybody's paying, that's still sitting at a year-over-year jump of 12.4%. And if you're going out to restaurants, food away from home, that's 8.6%. Energy, again, the headline number energy year-over-year, that's still a 17% jump year-over-year. And then fuel oil is still stubbornly high as I'm going through this report as well. Again, going through all the different numbers. I'm seeing, let me get down to used cars and trucks. We thought that was going to fall. It rose. That's interesting. It jumped month to month. It fell month to month 2.4%. So used cars and trucks, that number fell 2.4% month to month. Yearly, though, it's still a little bit higher. And I'm going down to shelter. That actually jumped 0.8% month to month. So shelter jumped 0.8%. Transportation services jumped 0.8%. And as you mentioned, Maria, shelter is still, that's about 42% of CPI here. So those are kind of the headline numbers that I'm going through. Medical care fell a little bit. That's actually good to see, because that had been jumping, and that was a piece of the report from last month that was actually really hot, was medical care services. That actually fell 0.6% month to month. And then new vehicle sales actually jumped a little bit, 0.4% for new vehicle sales. And then I'm going to keep going through this report and kind of give into some of the other things I'm looking for, like airfare. I would like to see those go down, guys. But I'm going to send it back to you right now.
All right, Cheryl, thanks very much. And we're talking with Jason Smith, the ranking member on the Budget Committee. Congressman, I just want to get your take on the adjustment to the health care insurance. This is one of the issues that a lot of the analysts were expecting to help. So Piper Sandler wrote this morning that we're going to see gasoline flip from last month's big drag to a headline, and we're also going to see a few more months of elevated shelter. That's exactly what we just saw, and we are also seeing an adjustment to health care insurance. So your thoughts on really where the inflation is? I know it's across the board, but in the month of October, we saw a bit of a cool down here, as Cheryl is reporting. Is this a temporary thing? What are your thoughts on these numbers?
Well, I was just doing a calculation. To me, the fact that the markets are rallying, according to what was said, because it was better numbers than expected, 7.7% is still hitting those numbers that the highest that we saw that until Biden got into office was back 40 plus years ago. And if you add 7.7% year to year here, but if you compare that number to how much has inflation gone up since Joe Biden's taken office, it's 14.4%.
Wow. Okay.
14.4%. And real wages, Maria, with those numbers now, real wages for real Americans has decreased 4.5% since Joe Biden's taken the oath of office. And that is what's affecting real Americans, just to put food on their table, clothes on their backs, and gasoline in their cars. And Maria, when you're out and about, I traveled to over 40 states during this election cycle. What I hear from American people is that they don't believe those numbers.
Yeah.
It is much worse than what 8.2% or 7.7%. They feel like it's much, much more worse because they've lost a month of their income.
That's right. And that's, of course, when you look within the specific things like a dozen eggs up 30% year over year versus, an 7.7% reading month over month. Congressman, it's good to see you. We will be watching all of the developments. Jason Smith, thank you so much. Joining us now to break this all down is Crossmark Chief Market Strategist Victoria Fernandez, former Council of Economic Advisors Chairman and Hoover Institute Distinguished Visiting Fellow Kevin Hassett, Missouri Congressman and House Budget Committee Republican Leader Jason Smith, we just heard, and joining the conversation all morning long, of course, Dagan McDowell and Todd Pyro and Mark Tepper. I want to get the panel's input in a second, but first, Kevin Hassett, you're up first here. How do you see this number? What's your read?
Right. Well, I wrote an article a few weeks ago in National Review describing the 10 stages of a stagflationary cycle, and we're right about at the middle stage where the inflation rate drops down to about the same level as wage inflation. And so I wrote, maybe about a month ago that the 8.5-ish number was going to go down to around 6, and then it was going to settle in around 6 until the unemployment rate started to go up and go up a lot. And so right now we're in a transition to a slightly lower inflation rate. It's not a sign that monetary policy is doing any miraculous thing. The hard part is to get wage inflation to start to drop when the unemployment rate is still so low. And another number that came out right today is initial claims, which are still very low. And so I think this is actually exactly the way the models say it should be going on. It shouldn't be surprising markets very much that inflation starts to drift down towards wage inflation as the economy softens.
Well, I mean, the market is rallying. We're talking about a gain of 850 points right now on the Dow Jones Industrial Average. Victoria, weigh in. Your thoughts on this number?
Yeah, I'm a little surprised that the market is reacting as strongly as it is. I mean, we knew prices were going to come down a little bit on goods, on apparel, on used cars. We expected that with supply chains doing better. We expected rents to stay where they are. We knew food and oil and gas were going to go up a little bit. So I actually don't see a lot of surprise in this. Obviously, base effects are higher from a year ago. So we knew that it was going to be more difficult to have a number above where we were a year ago from last month. So I'm not surprised by this. Again, I think it goes back to what we were just speaking about in regards to wage inflation, in regards to low productivity. That means employment cost is higher for corporations. Those are the things that I think we're going to be focusing on. I'm not sure this changes the path of the Fed whatsoever when it comes to the December meeting. I think they are still a full go.
Dagan.
Well, it doesn't change the path of the Federal Reserve if at every turn the market takes off. Because as we've said, as Nick Timmeros has pointed out, the Federal Reserve wants to see tighter financial conditions. And there is this knee-jerk reaction over and over again by speculators and investors, gamblers even, to buy the dip, thinking that the Fed is going to cool its jets, stand to the side. And so the more the market rallies, the more the Federal Reserve will stay the course. Stephanie Pomboy I emailed her before this report came out, and she said the shelter component here is the real problem because it lags home prices by 12 to 18 months. So by a year to a year and a half. So it's going to continue to reflect inflation levels that have long since shifted, and it's a third of the total index. So you won't see see a great easing in inflationary pressures from the shelter component for some time to come, when it's probably too late and the economy's in a deep recession next year.
Mark.
All right, so what I'm seeing here, number one, the Fed fund futures have not budged after this report. Not at all, not one bit. What I am seeing is that inflation for wealthier households seems to be slowing a little bit, but it is not slowing at all for lower income households. And when I go through the data and I look at groceries and you look at produce coming down 0.9% month over month, typically wealthier households, they're buying fresh produce, they're buying meat, they're buying seafood. Those numbers look a heck of a lot better than where lower income budgets typically go towards. They buy more ramen noodles, pasta, cereal, things like that. Cereal up 0.8% month over month, bread 0.9% month over month, pasta up 1.3% month over month. Where I am seeing deflation is in those ancillary businesses tied to the housing sector. So if I look at furniture, appliances, all the things that go with housing, that stuff has come down because we all know housing is in a recession right now.
That's a great point. Todd?
Mark, if I could follow up, sort of same church, different pew thought. Again, I'm going to get wildly out over my skis on this, but I look at these numbers and say, okay, this is for October. But what's coming up in November and December? We have everything's going to get real cold in the Northeast and throughout the country, so home heating oil is going to go through the roof. We also have the holiday season, which means demand for everything that you just mentioned, Mark: food, clothing, gifts. I'm going to throw in the mix. And then, of course, gas, because you want to travel to see grandma and grandpa. Isn't that significant? Skyrocketing of demand over the course of the next 2 months going to basically make this October number not that relevant, because we're going to see really high numbers again in November and December.
Yeah, by the way, you just said food. Look at eggs, because I know I used this as an indicator. Eggs, a dozen egg up 43%.
Up 10% month over month.
Exactly.
10.1% month over month.
Because it was up 30% last month. You're talking about year over year, 43% increase on eggs year over year. Cheryl, you've got more.
Well, the energy index rose for the first time from September to October. That had been falling for 3 months. So that month-to-month number, that jumped 1.8%. So we're talking about food, we're talking about energy. And the gas index, that jumped 4%. So, even though we're seeing, not the number we expected to get from the markets today, we're getting the 7.7% headline and the 6.3 core. Still, I think we have to kind of look at that. If we are seeing energy prices starting to tick back higher as we go into the winter months, remember the Energy Department has already told us they're forecasting electricity, nat gas, heating oil, all the things that Americans need and pay for in a lot of this country. Those are going to be double-digit increases for the winter months.
I'm glad you made that point, because you know what? It's also double-digit increases. The increase in crude oil since Joe Biden started depleting the Strategic Petroleum Reserve. Oil prices are up since he started doing that. Kevin Hassett, any more thoughts on this number? October CPI sending the Dow Industrials up 780 points.
Well, clearly the market thinks it's good news that inflation is headed down. The only thing I'm saying is it's kind of predictable that that'll happen, but it's going to be very, very gradual. We're going to get stuck at 6. And what we've been talking about, you and me, Maria, for a long time, is that we're going to know that we're sort of at the end of this tightening cycle when the federal funds rate is about the same as the inflation rate. And so every time the inflation rate goes down a little bit, that takes a little bit of pressure off of the Fed, but there's still a heck of a lot of rate hiking to come.
Yeah, exactly. Jason Smith, weigh in here. We got a rally underway. I guess the market is expecting that the Federal Reserve is going to slow down the rate hikes. But, these rate hikes have made carrying that $31 trillion in debt that much more expensive. We should point that angle out as well.
It sure is. I would just chime in. The folks who I represent, what they care about is the prices at the supermarket, not the prices at the stock market. And they care about the attack on their pocketbooks. And what we're seeing right now with just this report, energy being up 17% in October, that's going to be devastating for working class Americans. Think about this. More than a third of Americans have less than $400 in their savings account to prepare for a disaster. $400. And whenever they see the price of eggs and bread and energy continue to go up, it gets more difficult for them to put food on their table, clothes on their backs, and gasoline in their cars. And then what do you see? The Fed Reserve continue to increase rates. They've increased rates the fastest they have in 40 years just since March, 3.75 points. You look at that, and it makes it harder for everyday Americans just to get a home mortgage, to purchase a home. And I don't believe that it's a good time. And then just to finance our debt, $2.5 trillion in added interest expense over the next 10 years. Wow. That's a problem.
That is a problem. Mark Tepper, we have to look at this rally and try to figure out what this means. The Dow Industrial is up 830 points right now. Would you buy into this rally right here?
No. Look. The 3-month 10-year Treasury, which is not a part of the yield curve a lot of people talk about, that has been inverting a lot over the course of the last month or so. And that has accurately predicted 12 out of the last 11 recessions, which means there was just one false positive. So typically, when that one inverts, within 6 months, you are in another recession, which would signal a double dip recession. So I would not be chasing right here. I think you're going to get a heck of a lot better opportunity to get in 3 months from today, 6 months from today.
Victoria, you agree with that? How do you see markets?
Yeah, I do. I mean, look, Mark touched my heart a little bit there when he talks about the 3-month to 10-year spread. That's what we look at as well. That's the important part. And Kevin talked about the Fed funds. You have never had a bottom in the market until Fed funds is reaching where the inflation number is. And we are still, 250 basis points away from that. So I think you still have a tremendous amount of volatility in this market. I think on days like today, you go in and you start trimming some of the names that have done well. Take a little bit of money off the table, put that on the side, because you are going to have some pullbacks from this. That's going to be your opportunity to go into the market.
So you guys think this is a bear market rally?
I do.
Yeah.
I think it adds to what you've had before. We've had multiple bear market rallies so far this year. I think this is a knee-jerk reaction off of this number. I think once they start going through and seeing the month-over-month numbers are not as promising as the year-over-year, Fed's watching month-over-month, you're going to get a pullback.
Yeah, well, we'll see about a pullback going into the next meeting. The Federal Reserve will next meet on December 13th, and that's certainly going to be watched closely. They're expected to do at least 50 basis point hike in terms of that next meeting. Kevin Hassett, what are you looking for to see if this decline is sustainable?
Well, I think one thing is, and this goes back to something that you and the congressman were talking about before we all came on, is that if you look at 2023 spending that the CBO projects for federal government spending, it's $600 billion higher than they projected for 2023 just in 2019, right before COVID. And so the amount of runaway spending that has been added to the budget, especially by Joe Biden and the Democrats, is enormous. And so if we have a divided Congress, then a lot of the inflationary pressure that's been coming from runaway spending will start to abate, and the solution to this problem will be a little bit easier to craft for the Fed. And so I think one reason why the market might be celebrating today is that we're starting to believe that at least there's going to be Republicans controlling the House, and that maybe that's going to give us some spending restraint, because typically that's happened. But I can tell you that if you took about $200 billion off of spending, and so we're still $400 billion above what we thought in 2019, that would take about 1% off the inflation rate, and that would help us get closer to the goal.
Todd?
I just look at what this administration has constantly said when it comes to jobs as their number one defense to everything economic. But look how good the jobs numbers are. But over the course of the last month, just on this panel, we have been highlighting the fact that these jobs numbers are not going to be great deep into 2023. So this is really a question for Kevin Hassett to follow up of his earlier comment. When do you think we will really start to see the unemployment rate tick up to, enough so that this inflationary number goes down? Are we looking at February? Are we looking at June? Are we looking in a year from now?
You know, the labor market really lags, as you know, and this is a very, very unusual recession that's right now kind of on pause. But I think that what's going to happen is that the third quarter GDP got inflated by this weird trade story, which I know Maria talked about on the show. That all is going to reverse, and we're going to be looking at negative GDP quarters pretty much all throughout next year. And then at some point, the labor market will capitulate. I would guess around March, it would start to go up, and that it'll basically be about 2% higher a year from now than it is today. And at that point, inflation will start to head towards target. So
you are expecting a double-dip recession then?
Oh, sure, yeah.
Yeah, negative quarters every quarter throughout 2023. Where is the growth, if any? I mean, you're an investor. You've got to allocate capital. What are you doing, Mark?
Play defense. Be as safe as you can. And when I say defense, you know, defense is actually a good area right now. I mean, there is obviously bipartisan support. We have depleted not just our energy supply here in the U.S., but also our military weapons and ammunition. We've depleted that as well as we've sent more and more aid to Ukraine. So, you know, companies like Raytheon, as an example, that's one of our favorite picks, something that we hold where, you know, we would be comfortable continuing to add to something like that on pullbacks. Healthcare is attractive. You know, there's certain pockets where you can play defense. I think you want to stick with dividend payers. I know that's kind of a boring old story, but in these rising interest rate environments, you want to be working with companies where they are returning cash flow to shareholders right now.
You know, Cheryl, you're talking about energy being up year over year. I also wanted to get your take on healthcare. What are you seeing within these numbers as you drill down?
Well, we're looking at a slight drop month to month when it came to medical services, medical care services, a downward drop 0.6%. But overall, that number is still 5.4% year over year higher. And that has been one of the bigger contributors to the CPI report over the last couple of months, according to the Labor Department. On the energy side, one more thing I want to point out. By the way, airfares did fall 1.1%. I wanted to give you guys that. That number had been pretty high. So that was actually a little bit of a piece of good news. But fuel oil, 19.8% month to month rise in fuel oil. That is brutal. Wow. And it's almost 70% higher year over year.
Why is that? Why is that? Kevin, Jason, your thoughts on why fuel oil is seeing this huge move?
Well, Maria, this administration is pretty vocal about their war on U.S. energy, and whether it's proposals that they do in Congress of continuous tax increases on U.S. energy, just the president's budget alone wanted to add $45 billion in new tax increases, and then his statements every week is war on U.S. energy. So there's a lot of uncertainty within folks investing in energy, and that has to be a contributing factor to continue to increase the prices. But I hope that the American people know that help's on the way with the Republicans taking over in January and to be a check on this craziness.
Well, it's certainly an outsized number, Kevin. And, you know, the president gets in front of the podium and says the oil companies have to drill more. We need them. And then in the same conversation, he attacks them for being greedy. And then a day later, he says that he's going to shut all the plants, the coal plants.
And he threatens them with a windfall profits tax, right? And so, like, who wants to invest new capital in a sector where they're promising a huge tax hike? You know, the thing about home heating oil that we really should start all to watch closely is that it's so highly correlated with diesel fuel. And there's a massive diesel fuel shortage that's brewing in the country that could end up being super disruptive and inflationary. And so that's something I'm watching closely, is the super high correlation between home heating oil and diesel fuel. And the diesel fuel prices, if you drive by the pump right now, they're $1.50 higher for diesel fuel than it is for even premium gasoline right now.
So here we are smack dab in the middle of holiday travel season, and Cheryl kind of, you know, she got my hopes up with the airfare coming down 1.1% month over month. But then I looked at hotels up 5.6% month over month. So much for saving money and bringing down the cost of a vacation a little bit, unfortunately.
Well, I think you make a good point, because I think now we want to look at some of the groups within the stock market and see how they're performing, because that will give us a good indicator of what what markets believe is going to happen over the holidays. For example, look at what Dan Niles calls the generals in tech. That's Amazon, Microsoft, Google, all the major big tech companies. These stocks have been underperforming. They are down when the rest of the market is up. Now, today we've got, all boats rising in a market that the Dow is up 800 points right now, and big tech is included. But I'm wondering if this underperformance by big tech is indicating a weaker holiday spending season. 2/3 of economic growth is consumer spending, Kevin. And what are your thoughts on what we're going to be talking about within the coming month going into Christmas?
Right. Well, the thing that has been keeping consumer spending up, of course, is all those stimulus checks that people didn't eat that money all at once. They had a backlog of savings. But if you look at what's going on now with credit card debt and savings rates, you could see that people have pretty much run out of the cash that's been supporting consumption. And what that means is that real income is going to be the best predictor of consumption. And with wages growing, 3-4% slower than prices, that means real consumption has to go down. And so sadly, it's going to be, a tough Christmas and an even tougher New Year.
Jason, you just said that the American people are hurting and the GOP majority is going to be a real positive in that regard. Do you still feel as strongly, given that we're looking at the majority slimmer than many people expected?
The American people want the bleeding to stop when it comes to this reckless spending. And the Republican majority is united in stopping this reckless spending. So I'm very confident that we'll be able to make sure that this doesn't continue. Maria, one thing I do want to highlight that I think that folks have to look out to when you talk about future inflationary issues, there's still roughly $600 billion of unspent money that's out there in all these prior COVID packages that's still going to be out in the market and that should be very alarming in itself.
Well, that's what we were talking about earlier, the money that has not been spent or allocated. I guess it's been allocated but not spent. And, that brings you back to the basic definition of inflation, too many dollars chasing too few goods. Victoria, what do you think? Has inflation peaked? Does this number today suggest that to you?
I'm not sure it suggests that completely, for the sheer fact that we go back to the energy story here. And we know that the first week of December, we've got additional sanctions going into place against Russia from the European nations. To me, that means you're going to continue to see oil and gas prices move higher. That's going to lead headline inflation. So has it peaked yet? Maybe, maybe not. It's pretty close if it hasn't. I do think we go down to around 5.5% possibly by the end of the year. But that doesn't change the fact that you still have a Federal Reserve that's got at least 250 basis points still to go of hiking. And they're going to continue to push and get us right to the edge of the cliff where we think we lead into a recession probably spring or middle of next year. You talk about a consumer. Yes, they're decently strong right now, and we think that's what's holding up the economy. But the question is, how long does that last with revolving credit growing? Yes, it's still low relative to discretionary income, but it is growing. We're going into the holiday season, which is seasonally strong. So to me, I think we're going to see things get worse at the beginning of next year.
Yeah, I would be careful with this rally because you're also having to remember the Federal Reserve and the unwind of the balance sheet. So once $1 trillion comes out of the market as the Fed tries to unwind $95 billion a month, that's going to take an enormous amount of liquidity out of this market, and that's something to watch. So I don't know if this is a head fake or not, but you got a Dow Industrials up 800 points, Todd, and when people see the market going up, it is an indicator, and it sort of feeds on itself. The same thing when it goes down. That's what Alan Greenspan used to call the wealth effect.
Yeah, and people are going to look at today and think that everything is great when obviously the fundamentals of our economy are bad. We are in a recession. What I worry about, and this sort of alludes to what Mark and Kevin were talking about before, yes, I understand that a lot of our supply chain problems have been rectified. But what I worry about is if we have this diesel shortage and we have just an overall problem of getting goods from point A to point B within the United States, forget the whole getting them from China. How does that work with the supply and demand issues around the holiday season? How does that work with the increase in demand for home heating oil in the Northeast and other cold areas during the winter winter months. I think all this comes to a head in November, December, and then again in January.
It's such a good point because Congressman Smith, let's face it, Joe Biden tried to make us think there was no rail strike and they had a tentative deal. At least 2 unions voted against it. Any day now we could see a strike from the rail companies, and that's going to really add stress to this economy.
Yeah, Maria, I also want to point out, being a rancher myself, the price of diesel just in Missouri is just over $5 a gallon. Like Kevin said, it's $1.50 more than gasoline. Diesel is used in every aspect of producing our food supply.
That's a good point.
Whether it's animals, raising animals for meat, or whether it's just producing vegetables.
Yeah. We got to jump. Everybody, great conversation. Todd Pyro, Mark Tepper, Victoria Fernandez, Kevin Hassett, Congressman Jason Smith, Cheryl Casoni, Dagan McDowell. It has been a great conversation. Thank you for being here. Have a great day, everybody. Dow Industrial's up 787. Stu Varney picks it up from here, and Varney and Company. Stu, over to you.